Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Bloom Energy.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis. To really understand Bloom Energy, you first have to grasp the problem they're solving. Their whole focus is on reliable on-site power.
Right, distributed generation.
Exactly, using solid oxide fuel cell technology. So it's power that, well, it doesn't rely on the old fragile electrical grid.
And that exact point, that on-site reliability, that's why the AI market is suddenly all over this. We're talking about data centers that, they just can't go down. They need perfect, clean power 24/7.
You see it right in the financials. That demand it's translating into just enormous revenue growth.
The numbers are pretty staggering.
They really are. The baseline is strong, reported revenue of $1.47 billion, but the recent quarterly numbers...
That's where it gets interesting.
Yeah, a 57% jump year over year to $519 million.
And if you're asking where that's coming from, it's AI data centers.
Yeah.
It's the whole energy sector needing these kinds of solutions.
It is, but that incredible growth brings up, the big question.
The margin trade-off.
The margin trade-off. Operationally, things look great. Gross margins are sitting at a really robust 31.2%.
Which for a complex tech product, that suggests they have a good handle on their manufacturing costs.
A very good handle. It speaks to the efficiency of the fuel cell process itself.
Yeah.
But then you look a little further down the income statement.
And that's where you see the red.
That's it. The pre-tax profit margins are still negative, around minus 14.8%.
And that's the flag for a lot of investors, right? How long can you run in the red? We've seen other high-growth stories just fizzle out when they can't turn that corner to profitability.
True, but this feels different. It feels like a deliberate strategy.
So not a weakness?
I don't think so. I think it's purely a function of their aggressive scale-up. This isn't poor management. It's them making these heavy investments in R&D and critically expanding their manufacturing.
So they're sacrificing profits today for market share tomorrow.
Precisely. They're trying to capture the market now to serve these massive corporate partners. The idea is once they hit that scale, the margins will expand significantly because the underlying economics of the tech are sound.
It's a big gamble, but one that's protected by their competitive moat, right? The proprietary technology itself.
A huge moat.
So let's unpack that a bit. What makes their solid oxide fuel cell so different from, say, just getting a huge diesel generator?
It really comes down to two things: thermal efficiency and fuel flexibility.
Okay.
So other fuel cells, like PEM cells, they run at lower temperatures and they need pure hydrogen, which is still, a headache to store and move around. Bloom's tech runs at extremely high temperatures.
Which means more efficiency.
Way more efficient, more electricity for the amount of fuel you put in. That's huge for keeping operating costs down for clients like these Fortune 100 firms.
Right.
But the real game changer is the multi-fuel capability. They don't need pure hydrogen. They can run on natural gas, biogas, hydrogen blends.
So they're future-proofed.
Completely. As companies move from natural gas to cleaner stuff over the next decade, Bloom's platform just adapts. The customer doesn't have to rip out all their hardware.
And that creates incredibly high switching costs. If your multi-billion-dollar data center is running on this system, you are not swapping it out for a slightly cheaper competitor.
You're not. That IP-protected platform is their defense, and it's why we saw that big partnership with Oracle.
Huge vote of confidence.
It's a prime example. They're providing that essential on-site power for Oracle's critical AI data centers. It's high-value, non-negotiable power.
Okay, so they have the tech and the demand. Let's talk about how they're funding this.
Yeah.
This massive, capital-intensive expansion. The balance sheet looks pretty solid.
It does. Very low total debt-to-equity ratio, just 0.2. They've been really strategic about funding.
How so?
Well, they've already raised a significant chunk of capital, $2.2 billion through convertible notes.
Earmarked specifically for that R&D and manufacturing build-out.
Exactly.
But that brings up the risk, right? We have to talk about dilution. When you issue convertible notes, you're essentially promising to turn that debt into shares later.
And they're planning another big one. Another $1.75 billion in 0% convertible senior notes.
Which is great for liquidity, but what does that mean for the people holding the stock right now?
It's a real risk, and it's baked into the profile of a growth stock like this. That fresh capital gives them a massive cushion to execute their plan.
And 0% interest is obviously very favorable.
It is, but you're right, the potential for future shareholder dilution is there. Management is clearly prioritizing scale over protecting the immediate share count.
And every dollar of free cash flow is going right back into the business. No dividends, no buybacks.
It's all about growth, purely scaling up to meet that AI demand.
Which makes the stock's technical setup so interesting. I mean, the market clearly believes this story.
Oh, absolutely. The performance last year was, well, it was incredible. It delivered 16 times the S&P 500's return in 2025. That kind of move signals some serious enthusiasm.
But you have to look past the hype at the chart itself.
You do. The stock peaked around $120 back in early December, then had a pretty healthy pullback.
And it found a floor, right?
It did. It stabilized very nicely around that $90 level. Analysts are watching that now as an attractive entry point.
We even saw that 8% jump recently, which seems to confirm there are buyers waiting below 100.
A lot of buyers.
So when you look at that chart, what patterns are you seeing? You mentioned a cup and handle. For anyone listening who isn't a chart expert, what does that signal?
It's a classic bullish pattern, a continuation pattern. It looks just like it sounds, like a coffee cup with a short downward sloping handle.
And that handle was the pullback from 120 down to 90.
That's the one. The key signal is that this consolidation phase, the handle, it suggests the sellers are exhausted. Buyers are stepping back in, accumulating shares before the next attempt to break out above that old high.
And it's stronger when you see high volume, which we saw around that $90 level.
We absolutely did. Robust volume. And the momentum indicators are backing it up.
The golden cross.
The golden cross. During its last big rally, the 50-day moving average crossed above the 200-day. That's a classic sign that the short-term trend is confirming the longer-term uptrend.
Suggests institutional money is coming in.
Yes, and we're also seeing some constructive MESI-D momentum building again from these recent volume spikes. It all supports that breakout theory.
So then why the sharp pullback from 120 in the first place? If
Yeah.
everything looks so strong, the sentiment has been a little mixed.
It has. And the market is always going to worry about uncertainty. Those dips were really fueled by the two concerns we already touched on.
The negative margins.
And the executive share sales, that one always generates headlines.
It does. The reports of, 12 million plus in executive sales in December? To the casual observer, that looks like the C-suite is jumping ship.
It can, but you have to put it in context. It's crucial.
So what's the context here?
When you look at the filings, a lot of this selling, including the CEOs, was done under what's called a 10b5-1 plan.
A pre-established written plan.
Exactly. It's primarily to cover tax obligations on vested restricted stock units, or RSUs.
Which is a common form of compensation.
Right. So when those RSUs vest, they're treated as income, and there's a huge tax bill. So they have to sell a portion to cover it. It's a routine tax event, not a panic signal.
Especially when you see that institutional holdings are still substantial.
Exactly.
So in terms of managing those core risks, the margins, the dilution, how secure are they?
I think the market has already factored a lot of that in. The pullback from 120 priced in some of that concern. And critically, those capital raises, they've created a $2.2 billion liquidity buffer.
It's a massive runway.
It's huge. It buys them time, probably into 2027, to execute their plan and start hitting that margin inflection point without being vulnerable to short-term shocks.
Okay, looking ahead, the catalyst calendar. What's the next big event that could move the needle?
It's going to be the Q4 earnings report. We're expecting that late February 2026.
And the focus will be on revenue growth from AI.
All eyes will be on it. That's the next big test to see if this scaling strategy is really paying off.
And beyond earnings, the macro picture looks pretty good for them.
Incredibly supportive. This AI data center power surge isn't a one-year trend. This is a decade-long secular shift, and it plays right into what Bloom does best.
On-site resilient power.
Yep. And you add in expected interest rate cuts, which always help capital-intensive growth stocks, and the factors are really lining up for 2026.
And of course, there's always the speculative stuff, the rumor mill.
Always. Chatter about more data center deals, especially after that Oracle warrant issuance. And maybe even some M&A activity in the broader hydrogen space.
Which would obviously be a huge tailwind. It all comes down to execution.
They have the tech, they have the capital, now they just have to deliver the scale.
So what does this all mean for you? The investment thesis here seems pretty clear. This is a compelling growth story, and it's supported by some serious proprietary tech. They have a real competitive moat in what might be the highest growth sector of the decade. powering AI.
They do. They've got the funding, a powerful tailwind. The next big technical milestone is a confirmed breakout above that previous $120 peak.
But this isn't a short-term trade.
No, not at all. You have to be patient here. The target horizon is a multi-year hold, positioning for that margin inflection point, which should come deeper into the 2026 earnings cycle.
The ultimate question to ask yourself is, will the market tolerate a few more years of negative profits and dilution risk in exchange for capturing what could be just massive growth from AI's insatiable appetite for power?
Make sure you review your personal investment approach against this analysis, and remember to subscribe for more from Smart Wealth.